Debt-Free in 30, where every week we take 30 minutes and get practical advice from industry experts about personal finance and living debt-free. Here's your host, Doug Hoyes.
We haven't had a show yet this year where we've gotten ourselves into a lot of trouble with our heretical opinions, so today Ted Michaelis and I will make everyone mad by answering a seemingly quick clickbaity question. Are credit counseling agencies really nothing more than debt collectors? Let's start by talking about what debt collectors do. A debt collector, obviously, is someone who collects debts. I can think of two obvious attributes of a debt collector. First, they work for the creditor. They don't work for you. A debt collector works for the company that is owed the money. So if ABC Bank loans John some money and John doesn't pay, ABC Bank can hire a collection agency to collect that debt. Obviously, the collection agency is a debt collector because they are hired by the bank to collect the debt. The debt collector doesn't work for you, they work for the bank. They provide a service to the bank, and in return, the bank pays the debt collector. The second attribute of a debt collector is that they want to collect as much money as they can from you. That's pretty simple, right? A debt collector wants to collect the maximum amount of money from you. That's what they're hired to do. The bank wants to recover as much of their loan as possible, regardless of what you can afford. And the more the collection agent recovers on behalf of the bank, the more they get paid, since most debt collectors are paid by commission. So, how does all this apply to credit counselors? And to be fair, what about licensed insolvency trustees? Here's my take on this. Debt collectors, credit counselors, and licensed insolvency trustees fulfill different roles in the debt recovery business. However, when you look at the outcomes, credit counselors act more like debt collectors than debt relief experts. That's what we're going to explore today. To explain it, let's have Ted Michaelis join the conversation. Now, Ted, you've sat patiently while I went through that introduction. And quietly, very good. So let's start with the basics. What does a not-for-profit credit counselor do?
All right. Well, so their first responsibility is really educating the public. So they give budgeting advice, spending patterns, how to improve the way you're using your money. And they also do something called a debt management program.
So explain that.
Debt management program is a voluntary process whereby your debts, not all of them, but some of your unsecured debts are pooled together. So you make a single monthly payment to the not-for-profit, who then makes payments to your creditors. So an example might be, you owe a couple of credit cards and maybe an old phone bill, $10,000. Instead of trying to make 3 payments every month, you only make 1 payment to the not-for-profit.
And we don't do debt management plans.
We cannot. It's a conflict of interest, even if we could, because of the nature of our licenses. So a debt management plan, you're going to repay 100% of the debt. Probably you're going to get relief from the interest. And you're going to do it over preferably 4 years maximum, although they can stretch them to 5.
And in a consumer proposal, the maximum period would be 5 years. So the big difference, though, is in a consumer proposal, you're not, in most cases, paying your debts in full. Maybe you're paying back, a third or some lesser number.
In almost all consumer proposals, you're paying back less than 100% of what you owe, because the proposal is an alternative to bankruptcy. It's not an alternative to a debt management plan. So the debt management plan, the assumption is you can afford to repay 100% of your debt. Whether or not that's the right financial answer is a different conversation.
So and we can get into that. So the obvious difference is, in a consumer proposal, you're not paying back 100 cents on the dollar. In a debt management plan, you are.
Correct. That's a simple.
And so what are the other big differences between a consumer proposal and a debt management plan?
Well, I mean, the biggest single one is a consumer proposal. The consumer proposal is a legally binding process. You are taking advantage of the laws, so it provides you a level of legal protection. And by that we mean when you file a proposal, there's an automatic stay of proceedings. People can't continue with any legal actions they've started against you. So they can't take it to small claims court or superior court. They can't garnish your wages. If they've already started garnishing your wages, a consumer proposal will stop them. So a debt management plan isn't a legal procedure. It doesn't have any of those features.
It's a voluntary procedure, in effect.
That's right.
The creditors agree, fine, I'll take 100 cents on the dollar and I'll leave you alone.
Well, and there's certain types of creditors that have publicly said they're opting out, like payday loan companies want nothing to do with debt management programs. Revenue Canada generally is not involved in a debt management program, but they are by law included in a consumer proposal.
And that's a big difference. Okay, so with that background, let's get to today's question. Are credit counseling agencies nothing more than debt collectors? And so I want you to answer this question by giving both sides of it.
Okay.
So let's have you start by telling me why credit counseling agencies are not debt collectors.
All right. Well, we started by saying one of their main functions is to educate the public, to teach people about budgeting. Well, I've never heard of a collection agency offering to help somebody with their budget on the phone, except to say that you need to find $200 a week to pay me. I mean, that's the extent of it. Similarly, credit counselors generally will talk about spending habits, how to improve where your money goes every month. I've never heard of a collection agency offering to do that either. I mean, the area that they get into difficulty is that one of their primary sources of funding traditionally always was these debt management programs. And that really is, well, so I'm not answering your question anymore. This is a way that they're like collection agencies.
Okay, and we'll get to that.
Yeah.
So we've dealt with not-for-profit credit counselors for years and years and years.
Can't find any anymore, but sure.
And why is that?
Well, the government, bless their hearts, that's what I was told that the people in the South say when they want to call somebody an idiot. But they revised the laws effectively last year, whereby credit counseling, not-for-profit credit counseling agencies can't provide some of the services that they used to provide, or at least they can't do it easily. One of their sources of funding was always doing insolvency counseling for licensed insolvency trustees. And whenever you file a bankruptcy or a consumer proposal, you're required to attend at least 2 credit counseling sessions so that we can try to re-educate you, improve your financial management. And firms like ourselves, we used to subcontract all of that work because, in our opinion, the credit counselors were better suited towards providing that type of service. It's the kind of education that they want to do. It's not that we couldn't do it. We thought there was value added in funding these not-for-profits to provide this service to people.
Well, and if someone comes in to see us and they've got debt problems, those debt problems may be caused by other things. It could be an addiction issue. It could be gambling. It could be marriage problems.
They almost always are caused by, you don't just accumulate debt. It went
Something
somewhere
happened.
for something. Yep.
And so if we can send you to a not-for-profit agency that can do the credit counseling but also has other counselors and other specialties, that's better for you, because you're getting a more all-encompassing...
Yeah, that's the way we always used to think about it. So they changed the laws last year. The government's been trying to reduce the involvement of debt consultants in the insolvency process. Now, a debt consultant is somebody that basically charges you a fee and says, I used to file a consumer proposal with a trustee. And many of the debt consultants were disguising themselves as credit counselors. The issue being that nobody owns that term, credit counselor. So the government didn't license credit counselors. They had no control over who called himself one. And so in the government's objective, at least I think this was their objective, to reduce the impact of debt consultants, they took a major swing at credit counselors. And the not-for-profits, the vast majority of them no longer provide any credit counseling services because the funding model's dried up.
Yeah, and I want to talk about that funding model, and we'll get to that. So, I think you and I would both agree that over the last 30 years that we've been doing this kind of work, we've seen a huge change in the credit counseling world. The local agencies, where you used to be able to go in, sit down face-to-face like we're doing here, and have someone walk you through budgeting, looking at your numbers, it's just not a thing anymore. Now, you alluded to the government changes. Up until October 1st, 2018, if we had a bankruptcy or consumer proposal client who wanted some detailed budgeting advice or, like I said, needed some specialized counseling, we wouldn't hesitate to send them for their credit counseling sessions to a full-service, not-for-profit agency. And now the rules are so cumbersome that it's very difficult for us to send them outside. And I'm not going to go into the changes to the rules. Suffice to say, it's much more cumbersome now for us to do that. And now in some ways that's good for our clients because they stay in-house. We can help them all the way through. And we now have, I think, something like 17 licensed BIA, Bankruptcy and Insolvency Act, insolvency counselors on staff, in addition to all of our LITs who are also fully accredited. So that's over 35 people in-house who can do credit counseling. So in most cases, that's great for our clients. But like you said, there are cases where it would be good for our clients if we could easily get them additional help, and that's very difficult with the current rules. But I'm digressing here.
Right.
So let's get back to the topic. So you've explained why traditionally credit counseling agencies were not debt collectors. Give us the other side of the story. why do many people now consider credit counselors to really be debt collectors?
Well, so let's focus on what's been left in the not-for-profit credit counseling community. 2 or 3 very large national firms that derive almost all of their funding from the fees that they receive from the lenders for completing debt management programs. So the model is this. They negotiate a debt management program, which really isn't much of a negotiation. You're going to repay 100% of your debt over 4 or possibly 5 years. And once those payments are made, the lenders, the creditors, the people that you're indebted to, they call it a donation, a contribution. They make a payment.
A fair share, voluntary contribution.
Right. So they make a payment back to the agency. I've got no problem with people being paid to do their work, but now the only thing they're getting paid for is to collect on debts. And one of the definitions of a collection agency is they get paid for collecting on the debts.
Well, and they have to be registered with the Ontario government as a collection agency.
Well, that's the kicker on this, because now all of these national agencies are licensed as collection agencies, even though they're credit counseling agencies. So the line it's completely disappeared.
Well, and for any of our listeners who want to fact check us, I'll put a link in the show notes to the Ontario Ministry of Government and Consumer Services. And you can go there and you can type in the name of any not-for-profit credit counseling agency, and you can see whether or not they are registered as a collection agency. So why do you think it is that credit counselors are required to register as collection agents?
Well, because effectively they are collecting on behalf of a creditor. I mean, the reason that the government created the registration system in the first place is so that there's some sort of accountability. There are regulations in place, there are rules, because quite frankly, a lot of collection agencies have pretty poor reputations for some of the tricks and techniques that they use. They used to send out documents that looked so much like they'd already been to court to scare people that actually the lawyers had to step in and ban that practice from the lawyers that were associating with it. It's just so easy to manipulate people on the phone or by text over the internet to scare them into doing things that they shouldn't, that licensing is required and regulations are required. And now those same regulations apply to these national credit counseling agencies because effectively they're collecting for creditors. Now, given the choice with somebody dealing with a not-for-profit credit counseling agency as a collection agency versus some of these people I was just describing, you'd much rather deal with the not-for-profits, but they don't get your account. I mean, they don't buy accounts from the creditors. You go to them asking for help, and effectively it's kind of a reverse collection agency. You're voluntarily saying, I need help paying these things, and so you hire them to do it, as opposed to the collection agency hiring them, but it's still the collection agency, the creditors that are paying them.
Yeah, and it's the Ontario Collection and Debt Settlement Services Act, which is where this is defined. I mean, it defines a collection agency as anyone who obtains or arranges for payment of money owing to another person. So you're right. If a credit counselor arranges for you to make payments through a debt management plan to your creditors, they're acting as a collection agency.
Now, you'd think then that would apply to us, right? Because effectively, we are collecting money to repay debts. Of course, we're only repaying a portion of the debt, or none at all, depending on the situation. But there's a specific prohibition in the law excluding licensed insolvency trustees.
Section 2, sub 1, sub C. You're exactly right. And it says that the act does not apply to a trustee licensed under the Bankruptcy and Insolvency Act. It's a law. So why do you think then that the government, when they drafted this law, specifically said that a credit counselor is a collection agent, but a licensed insolvency trustee is specifically not a collection agent?
Yeah, I mean, I'm not going to try and second guess politicians because I don't know that I can dumb myself down that much. But effectively, let's look at who's initiating the contact, who's paying who for what service.
Follow the money.
Right? Always follow the money. So in a debt management program, the not-for-profit agency sets up the program, holds the funds for you, and advances it to the creditors. The creditors then make a return payment to them. That's how the money actually flows. It goes from you to the not-for-profit to the creditor, the people that you owe, back to the not-for-profit. So it's a pretty clear stream of where the money goes. With a licensed insolvency trustee, the money is held in trust. A fee is deducted before any monies are released to the creditors. But the trustee's obligation is to the entire community. So we have an equal obligation to you, the person in debt, as we do to the creditors that are owed the money. The best way to think of an LIT, in my opinion, is that we're referees. We're there to design and monitor and control the legal remedies for people to get relief from debt. Whereas a debt management program and a credit counselor doesn't have that. It's not the same relationship at all.
Yeah, and I guess that goes back to the first attribute of a debt collector. They work for the creditor, not you.
Yep.
And, that's why you follow the money if you want to figure it out. So whomever is paying you is who you are working for, and credit counselors earn the majority of their income from the banks they are collecting for. So now everyone's listening, and they're going, oh, okay, that makes sense. But you guys, licensed insolvency trustees, you don't work for free when you do a consumer proposal.
It's true.
And you end up sending money to the same creditors. We're sending to the same banks and whatnot, credit card companies. So doesn't that also make us a collection agent then?
Yeah, again, the difference, and maybe you're thinking this is just semantics, is the actual flow of the money. So we don't have any kind of relationship with any of the lenders, any of the credit grantors. You come to us, we contact your creditors, and we say, Jane Doe is going to offer to repay a portion of their debts. And they do that by making payments to us, which we hold in trust, and then we deduct a fee before those funds are released to whatever creditors the person owes money to.
So the banks, unlike with a credit counselor, are not sending us money. We're sending money to them. So explain in simple terms, how do we get paid then?
Well, and so let's talk about a proposal first, because that's what we're comparing to the debt management program. In the law, it simply says there's an administrative fee of 20 cents on the dollar for any money to be sent to creditors. So we are getting paid by whomever is making the payments into the proposal. So if I make a $100 payment and I was going to send that $100 to your creditors, well, the $20 would get paid to me for doing that first. There's no contractual relationship between trustees and the creditors. Now, there is a contractual relationship between the not-for-profits. I mean, they signed that fair share contribution agreement with I think it's the Canadian Banking Association.
Yeah, I think they now do it on an individual basis. Each one negotiates their individual one. But you're right. Our relationship is federal law. There's this federal law that says if a consumer proposal is accepted, then we get this percentage. And you're right. It's a percentage of what's in the pot.
Right.
So if we've got $1, some of it goes to us, some of it goes to the government because they're regulating this process, and obviously the rest goes to the creditors.
And we're not setting up a 100 cents on the dollar program. There's some finesse to this. When you talk to a licensed insolvency trustee, we're going to compare with what your proposal needs to be by, what would your creditors realize in a bankruptcy? And again, folks, if you're not familiar with bankruptcy, you're saying, I can't repay any portion of my debt. So there are very specific rules on how much you have to pay under what circumstances. Proposal is going to offer a better repayment to the creditors than a bankruptcy. That's one condition. The second is that it has to offer enough money that the creditors will agree. You earlier said it's about a third, and most of the Canadian banks have told us we want at least a third of our money back. That's dramatically different than 100% in a debt management program. There's no finesse involved there. It's give us our money.
Yeah, and a third is a ballpark number. There are lots of proposals we do that are 15 cents on the dollar. There are lots that we do that are more than that.
Correct.
But you're right. It's not just a blanket. You're paying everything back. It's not as simple as that. So, okay, we get a percentage of what our client pays, and the rest. The government gets some. The rest goes to the creditors. We send money to them. They don't send it to us. So it's pretty obvious. I think we're not working for the creditors now.
Right.
I want to go back to something you had said earlier. When all of these not-for-profit agencies started, they were not-for-profit agencies, and technically they still are. And that's a difference between us and them. We are not-for-profit. We are a business.
We are a for-profit corporation. If we don't provide value to our clientele, then they'll look for future services someplace else. I mean, it's
as simple as that.
Yep.
So, okay, so we are not-for-profit. We are also not a charity.
Correct.
And there's a difference between those two words. And this is something that kind of grates on me a little bit because you can be a not-for-profit organization and not be a charity. Not-for-profit just means that you are not trying to make a profit.
Well, you know what you could put in the program notes? We had a couple of these large national credit counseling agencies lost their charitable status.
Well, let's talk about that because you're right. So a charity is an organization that is engaged in charitable works. Okay, and I actually looked it up on the Canada Revenue Agency website because they regulate this, and I'll put the link in the show notes. They say that registered charities are charitable organizations that must use their resources for charitable activities and have charitable purposes that fall into one or more of the following categories: the relief of poverty, the advancement of education, the advancement of religion, other purposes that benefit the community. So a charity is doing something good for society as a whole.
Right.
Makes sense. That's different from a not-for-profit organization that's doing something good for its members. So examples of a not-for-profit organization would be things like a social club. I'm sure
the Kids Soccer League.
The Kids Soccer League, exactly right. A sports organization, something like that. Now, in the past, not-for-profit credit counseling agencies, as you alluded to, were also registered charities because they were doing education and helping people with their money and their debt, which of course benefits the community, fewer people under stress, that sort of thing. But today, most of the big credit counseling agencies are not registered charities.
Right.
For example, Credit Counseling Services of Atlantic Canada is a large not-for-profit credit counselor, obviously in the Maritimes, and they became a charity in 1993, but their charitable status was annulled in 2013. And again, let me be clear. I'm going to quote from Revenue Canada, CRA's website. When a charity's registration is annulled, it is deemed to have never been registered.
Right.
Annulments generally occur when registration was granted in error. An organization whose registration has been annulled can no longer issue donation receipts for income tax purposes and is no longer eligible to receive gifts from registered charities. So that means that the organization was not doing charitable works. And that makes sense because if what you really are is a collection agency, that's a business and you're getting paid for doing that business. So obviously you're not a charity.
Right.
Another big credit counseling agency is Credit Canada Debt Solutions. They were registered as a charity in 1967, and their charitable status was annulled on September 27th, 2018. Now that is amazing to me. Mm-hmm. They were registered as a charity for over 50 years, and then someone realized the registration was in error and it was annulled. I mean, something kind of strange is going on here.
Well, but if you look at the financials for either of those organizations, it becomes immediately obvious that they're not charitable organizations. I'm not saying that they're for-profit. Well, actually, I will say that they're for-profit, but they don't satisfy the criteria. The vast majority of their revenues and the vast majority of their operating expenses were going towards the management of these debt management programs. It wasn't to providing educational services or community support or any of those other charitable activities.
Well, and you're actually right, because I did some research on that exact topic, and I'm going to put some links in the show notes to this. One of the biggest credit counseling agencies in Canada, probably the biggest, is the Credit Counselling Society of British Columbia. In 2017, and these are financial statements, they are still registered as a charity. And so you can pull these off Revenue Canada. It's public information. You can pull them off Revenue Canada's website. In 2017, they issued tax receipts for $71,000 in donations. They earned investment income of $228,000, and their total revenue from the sale of goods and services was over $13.5 million.
Right.
That sounds like a business to me, not a charity. And let me be very clear. They earned $13.5 million, largely collecting money on behalf of banks and lenders. Now, before we get all high and mighty, probably too late. I think I've been high and mighty now for the last 5 minutes here. But Are we, overstating this? Are we making a mountain out of a molehill? Hoyes, Michaelis and Associates is a business. We help people deal with their debts.
Right.
The big credit counseling agencies are businesses. They help people deal with their debts. So what's the big deal here?
Fundamentally, the question is, are you going to be more inclined to deal with a not-for-profit or a charitable institution to deal with your situation than you are a for-profit corporation? I think there's a bias in the language that you assume that, well, it's a not-for-profit, it's a charity, they're not there to try to make a buck, they're there to, their only real impetus is to try and help me. And the issue is, of course, that I'm not sure that's an honest representation of what they do. If you had $71,000 worth of charitable donations and $13.5 million worth of revenue from banks, I'm pretty sure they're working for the banks.
Well, and in fact, you can go to their websites and look to see who their supporters are, who supports their educational programs and whatnot. And it is largely, banks, credit card companies, that sort of thing. So this show, we're not here to trash anyone, although I guess that's what we've done for the
we pretty much have.
last 10 minutes. But, we're here to give practical advice. So, and you already alluded to this. There is a bias that, you're a not-for-profit, you're a charity. I want to go talk to you. I don't want to go talk to, big bad Ted Michaelis who's in this to make money.
Right.
If you have debt, how do you decide if you should call a not-for-profit credit counselor or a licensed insolvency trustee? I mean, if we all make money for helping you with your debts, is there really any practical difference?
Well, and maybe at the end of the day, there isn't. I mean, a licensed insolvency trustee has a fiduciary responsibility to explain to you all of your different options. That's going to include talking about debt management programs. So if you're an individual that can afford to repay 100% of your debt, well, then maybe the debt management program is the right solution for you. It's going to have the same hit on your credit report as a consumer proposal, and a consumer proposal you're likely going to pay less than 100 cents on the dollar, but there are times when it was the right solution. Now, I got to be honest, I don't recommend it much anymore because all the local agencies are gone.
But let's talk about that then. So there are times when a debt management plan is the right solution. So, okay, give me some examples then. I mean, when, it's not obviously a bad idea all the time.
Right.
There are cases where a debt management plan might actually be the correct answer.
Yep.
So when would that?
See, I always thought when the local offices were in place, the debt management plan was the correct solution if you had a limited amount of debt. So maybe you owed a couple of credit cards and a utility, maybe an old landlord that the local agency knows is receptive to these kind of deals, because you can't force people into one of these programs. So let's say, you owed maybe $10,000 or $12,000. You need time to get back over a hump because something bad happened. You're off work for a couple of weeks, you got sick. It really doesn't matter what the reason is. $12,000 over 4 years, you're looking at $250 a month. It's a number that's manageable. You get into the $30,000, $40,000, $50,000, $60,000 and you're trying to do a debt management program. Suddenly they don't make as much sense. If you're paying back 100 cents on the dollar on $50,000, your monthly payment over 4 years is $1,100. I mean, it's not manageable for most people anymore.
So a debt management plan would make sense if your debts are, moderate. Yeah, okay, I could get them paid off in, a couple of years. I need a break on the interest. And obviously it has to be with favorable creditors. So like you said, the local agency knows the local hydro company, the local, whatever, they can work something out.
And automatically, payday loans will refuse to participate, and automatically the government's not going to participate. Although there were debt management programs focused on student loans. Maybe that's a different program when we talk about student loans again. But
again, if it's a government-guaranteed student loan, then the government has to be agreeable to it.
Right.
So one of the other,
Now, I think those debt management programs are gone, by the way, because they were provided by the local offices. And I just don't think, the local offices are gone.
Yeah, this is the problem. That we used to send people to, Guelph would be a classic example. And you've been in Guelph for decades and decades.
Right.
And they just don't exist anymore. There is no one there to send someone to.
That's right.
To sit down, work out a budget, work out a debt management plan, whatever it is. So now you alluded to a couple of reasons why someone would want to go to a not-for-profit agency. One is they're not-for-profit, they're a charity, so obviously they're, pure.
Mm-hmm.
The other reason was, it's going to look better on my credit report.
Right.
You're saying no.
No. So a very quick credit report lesson, folks, is the numbers, the rating from 1 to 6 are your payment frequency on your debts. If you make regular payments every month, it shows as a 1. At 2 months, it's 2s. 6 is used if you haven't paid in 5 months. 7 is used when you've entered into some sort of settlement on your debt. And there only really are 2 types. It's a consumer proposal or a debt management program. So regardless of whether or not you're paying 100 cents back on the dollar on a debt management program or 30 cents on the dollar on a consumer proposal, it shows the same on your credit bureau report.
Yeah, so there's no big advantage to going the other route.
And this is another program, but don't ever make your debt relief decision solely on what happens on your credit report, because people are so confused and and misunderstand how credit reports work, that it's just a bad basis for a decision.
Yeah, a better basis is if I do a debt management plan, I'm going to have to pay $1,100 a month in the example you gave. In a consumer proposal, maybe I'm paying $300.
Yeah, that's a perfect example.
So, okay, that's not a hard decision to make, particularly when they're both going to show up essentially the same on my credit report.
Well, and which one is going to solve the problem? Probably $1,100 a month isn't going to solve the problem
because I can't afford it.
And in 6 months, you're going to file the consumer proposal anyway.
So a consumer proposal is a better option than when your debts are large.
Your debts are large. If you've got government debts, payday loans, if your situation is complicated. And by that, I mean if you got more than 3 or 4 creditors. Because the more creditors you have, the more difficult it is to get any kind of debt management program agreed to. I mean, it's a voluntary program. You're paying back 100 cents on the dollar, but you can't compel people to.
Yeah, and if you have 10 different creditors and they can make a deal with 8 of them, that still leaves 2 who are yelling and screaming and threatening to take you to court. In a consumer proposal, if the majority of the dollar value agrees, everyone else has to take the deal.
Right.
So it's a lot easier to make it compelling. So, okay. Because a debt management plan requires the debtor to pay back 100% of their debt, it's often not the best outcome for the debtor. And again, we talked about debt collectors wanting to collect as much as they can from you. That's what a debt management plan does. And of course, that's not the objective as you've explained in a consumer proposal. Our goal is let's get a reasonable number. Now, a lot of people say, well, yeah, but you trustees, you already explained that you get a percentage of what's in the pot, so you'd much rather the person pay $1,000 a month than $500. And I say, no, I would much rather you pay what a reasonable number is that we can get the creditors to agree to. Because if I force you into some $1,000 a month plan that you can't afford, it's just going to crash anyways, and you're not going to be able to pay it. So that makes no sense either. So again, we explain your options and hope we come up with the correct option for you. So what is the difference then? We've talked about the difference between debt management plans and consumer proposals. What's the difference between a licensed insolvency trustee and a credit counselor?
Well, okay. So the most obvious difference to me is that there's no such thing as a licensed credit counselor. So anyone who wants to can call themselves a credit counselor. Nobody owns that term. And I think that's the mistake the government made 30, 40 years ago that allowed the debt consultants to migrate away from that term, debt's bad, to credit counseling, sounds good. Mm-hmm. Biggest single difference is the vast majority of licensed insolvency trustees are also chartered professional accountants. That's not to say that those that aren't chartered professional accountants are any lesser or different, but we are professionally trained to deal with finance, accounting, debts, debt relief, debt restructuring. It's what we do. It's why we're paid the big money. You can look to see what my credentials are. You can check to see that my license is still valid, that I'm not in some sort of abeyance or under some sort of restrictions. I mean, that would be a pretty rare thing, but there's nowhere to check if a credit counselor is actually legitimate or not.
Yeah, you can go on to the Office of the Superintendent of Bankruptcy's website, do a search for a licensed insolvency trustee, punch in Hoyes Michaelis, punch in Hoyes Michaelis, whatever, and you will see that we exist there. And
about half the people we talk to don't require our services. We're able to assist them by either pointing them in the right direction, maybe sending them off to refinance their home, or they just needed some budgeting advice. You're not going to find a credit counselor that turns away half the people that call them. It doesn't, because you called them because you got a debt problem. They're going to put you in a solution.
They want to help you. And your point about the word credit is right. And I was thinking, didn't I talk about that in my book? Yeah, I did. I had to get the book in here somewhere. Myth number 4, give credit where credit is due. And basically I made the point that you just made, that credit is a positive term.
Yep.
So I don't want to be called a debt counselor. I want to be called a credit counselor because that's a more positive thing. So, okay. Let's cut to the chase here.
Right.
You and I have worked with not-for-profit credit counselors for over 20 years.
Right.
They, I think we both agree, can be great money educators. They can be great at helping people with budgeting and other money management issues. I object to them suggesting debt management plans when a consumer proposal or some other option would be better for their clients. That's what you just said as well.
Yep.
And I definitely object to them hiding behind the words not-for-profit and charity when really what they are is a business, because I think people go to a not-for-profit counselor instead of an LIT for the reasons you just said. It sounds more pure.
Yep.
I think if credit counselors were honest and told their clients up front that most of their living or most of their funding comes from the big banks, people would perhaps think twice about using them. Again, the point that you just made. Now, I get it. They need to pay their staff. Mm-hmm. They need to keep the lights on. They need some money coming in. people in debt don't have money to be paying for advice.
Right.
So credit counselors can't charge them a fee for advice. They aren't like, fee-only certified financial planners who charge you by the hour and, aren't selling you anything, so you're getting relatively unbiased advice. A credit counselor only has two obvious ways to generate funds. They either do debt management plans and get the contribution back from the bank, or they take sponsorship money directly from the banks.
Right.
And because that's where the money is, but obviously that's the problem. Not-for-profit credit counselors have a funding problem.
Definitely.
This is the big issue. I believe that the vast majority of them are very good people. Yep. They really want to help people. They want to do good, but they also need to have money to do these good works.
Right.
So what is the solution? How can credit counselors help people without appearing to be on the payroll of the big banks, which in my mind is a conflict of interest?
Yeah, I think that the government really screwed up when they made the changes last year because they took out one of the legs of the stool, one of the funding models that credit counselors had, in that we would pay them to provide insolvency counseling to all of our clients. We're not even allowed to make donations to them or contributions to have a trade show or something now because it looks like we're trying to curry favor or buy bias from them or something. Until they can settle on a model where they're paid for their services to give unbiased financial planning, education, I don't know that there is a funding model for them anymore.
And that's kind of the difficulty.
Right. And our communities are much worse off. I mean, we went to providing our own service because we had to. We honestly believe that the communities were better served by the not-for-profits giving this advice because they could always talk about substance problems or gambling problems or relationship issues, or maybe I got a problem with my landlord. All of these community knowledge-based things that they were tied to that we are not tied to as well. We are professional accountants. We're going to restructure your debts. We're going to solve your financial problems. But there's always an underlying issue in your life. That'd be nice if somebody helped you with that too.
And that's the crux of the problem.
Yep.
Ted, thanks very much. I know some of you are watching this and thinking that Ted and I don't like credit counselors. You're thinking that we want you to come to us, not to them, so we're saying bad things about them. No. We've worked very closely with many agencies for more than 20 years, and I would love it if they could find a way to fund all of the good work they do without having to resort to having the big banks as their main source of funding. On this podcast, we talk about the dangers of credit cards and big car loans and mortgages. Those are products offered by the big banks. Would I be willing to say bad things about credit cards if my main source of income was the big banks and credit card companies? Probably not. In my book, Straight Talk on Your Money, I made a lot of points that the banks don't want you to hear. That's how you know I'm not on the payroll of the big banks. So what's the solution? How can we support not-for-profit credit counselors so they can give unbiased advice to Canadians who need help with money management and don't want a sales pitch from the banks? I don't know the perfect answer, but how about considering changing the model entirely? Let's have licensed insolvency trustees who are federally monitored and regulated and who don't work for the creditors do debt relief programs. Let's have not-for-profit credit counselors do what they are good at, education. So how can we fund it? Perhaps a coalition of members of the financial services industry could find a way to provide long-term sustainable funding. We could even funnel money from licensed insolvency trustees to credit counselors, either by allowing us to send credit counselors work to them again, as Ted mentioned, or perhaps through a supporting funding model. LITs pay a fee to the Office of the Superintendent of Bankruptcy for every consumer proposal and bankruptcy we file. This year, there will be over 120,000 filings in Canada. What if the fee we pay was increased by $10 a file and that money was distributed to not-for-profit credit counselors registered as charities whose sole purpose was to educate and help the public? That's over $1 million of funding. And what if the banks agreed to kick in some money? They make literally billions of dollars in profit every month. A few million a year shouldn't be a big deal, and it shouldn't only be done under the hidden agenda of having the credit counselors act as debt collectors for them. And if they were registered as charities, anyone who wanted to improve the financial literacy of Canadians could make a donation and get a tax receipt just like they can do with any other charity. Will this be a better model for consumers dealing with debt issues? I don't know, but it's time to start the discussion and come up with some answers. Hopefully today's show is the start of that process. That's our show for today. I've got links to everything we talked about today, legislation, Canada Revenue Agency, and a full transcript of today's show in the show notes over at hoyes.com. That's HOYES.com. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.